It's a quiet Tuesday morning. Margaret, a 71-year-old widow from Ohio, sits at her small kitchen table with a cup of coffee growing cold beside her. In her hands, she holds a letter from the IRS. Her fingers are trembling. The letter says she owes the federal government over $11,000 in back taxes, penalties, and interest. Margaret reads it again. And again. She doesn't understand. She did everything right. She filed her taxes every year. She took money from her IRA, just like the bank told her to. She gave generously to her church. She lived a careful, modest life. So how is this possible? Then her phone rings. It's her bank. They are calling to tell her that her Medicare premium just jumped by over $400 a month. $400. That money is coming directly out of her Social Security check. Starting next month. Margaret puts the phone down. She looks at the letter, she looks at her checkbook, and she realizes something terrifying. She doesn't actually understand the tax rules that govern her own retirement. And neither do most retirees in America today. If you are watching this video right now, sitting in your living room or kitchen, worried about your benefits, your savings, or your future, I want you to listen very carefully, because what I am about to share with you could save you thousands of dollars and protect everything you have worked your whole life to build. My name is Masha. I am a senior policy analyst, and for years I have helped retirees just like you understand the complicated, often hidden rules that quietly drain their retirement income. Today, I am going to walk you through 6 simple tax questions. If you can honestly answer yes to all 6, you are ready to retire safely. But here is the truth most retirees do not want to hear. Most people cannot answer question number 4, and that single question is the one that costs retirees the most money every single year. Please stay with me until the very end, because near the end of this video, I will reveal the one quiet mistake that retirees make over and over again. A mistake that can wipe out years of careful planning in a single tax season. You do not want to miss it. Let me tell you about Robert. Robert is 73 years old. He retired 5 years ago after working for 38 years as a high school principal in Pennsylvania. He has a modest pension. He has Social Security. He has a traditional IRA he saved into for decades. And he has a small Roth IRA his daughter helped him open a few years back. Robert is not rich, but he is comfortable. He owns his home. He drives a 10-year-old Buick. He plays cards with his friends on Thursdays. And Robert thought he was doing everything right. In 2024, Robert decided to do something his neighbor told him about. He converted $40,000 from his traditional IRA into his Roth IRA. His neighbor said, "Robert, this is smart. You pay the tax now and your money grows tax-free forever." Robert agreed. It sounded smart. He paid the tax bill that year. He moved on with his life. But then, 2 years later, Robert opened a letter from Social Security. His Medicare Part B premium had nearly tripled. He went from paying around $200 a month to paying over $500 a month. His wife's premium went up by the same amount. That one decision, that single Roth conversion he thought was smart, pushed his income across an invisible line. A line he did not even know existed, and the penalty followed him 2 years later, like a shadow he could not shake. Robert lost over $5,000 in extra Medicare costs in a single year, and nobody warned him. This is not Robert's fault. The rules are hidden on purpose. They are buried in IRS publications and Medicare fact sheets that almost nobody reads. But today, I am going to bring them into the light. So let's go through the 6 tax questions, one by one, slowly, clearly, calmly. Question number 1. Do you know the income threshold that makes your Social Security taxable? Most seniors believe their Social Security check is tax-free. This is one of the biggest myths in retirement. Here is the truth. Straight from IRS Publication 915. The IRS uses a formula called combined income, sometimes called provisional income. It works like this. You take your adjusted gross income. You add any tax-free interest you receive. Then you add half of your Social Security benefits. If you are single and that combined number falls between $25,000 and $34,000, up to 50% of your Social Security can be taxed. If you are married filing jointly and that number falls between $32,000 and $44,000, the same 50% rule applies. But here is where it gets serious. If you are single and your combined income goes above $34,000, or if you are married and it goes above $44,000, then up to 85% of your Social Security becomes taxable. Now listen to this carefully. These thresholds have not changed since 1984 and 1993. They are frozen. They do not adjust for inflation. So every year, more and more retirees get pulled into this tax trap simply because the cost of living went up while the threshold stayed the same. The trap is this. A retiree pulls money out of their IRA, sells some stock, or does a Roth conversion. They think it is just a normal withdrawal. But that one transaction can push their combined income over the line, and suddenly, 85% of their Social Security check is being taxed. The protection is simple. Use the worksheet inside the Form 1040 instructions before you make any large withdrawal. Or file Form W-4V with Social Security to have taxes voluntarily withheld at 7, 10, 12, or 22%. If you ignore this rule, the IRS can also charge you an underpayment penalty under Section 6654 of the tax code if you did not pay enough in estimated taxes during the year. Question number 2. Do you know your required minimum distribution age and deadline? This rule has changed 3 times in the last few years, and most seniors are still confused. Here is what is true today, straight from the IRS website and the Secure Act 2.0. The required minimum distribution age, what we call your RMD age, is now 73. If you turned 72 after December 31st of 2022, your RMD age is 73. And in the year 2033, that age will rise again to 75. Your first RMD must be taken by April 1st of the year after you turn 73. Every RMD after that must be taken by December 31st of each year. This rule applies to traditional IRAs, SEP IRAs, simple IRAs, 401k plans, 403b plans, and 457b plans. Roth IRAs are different. If you are the original owner, you never have to take an RMD from your Roth. Here is the trap. Many seniors still think the age is 70 and a half or 72. That is old information. And many seniors who do know about the 73 rule decide to delay their first RMD until April 1st of the next year. They think they are saving on taxes. But what actually happens? They end up taking 2 RMDs in the same calendar year. That doubles their taxable income for that year. It can push them into a higher tax bracket. It can trigger Medicare surcharges. It can make 85% of their Social Security taxable. The protection is this. If you miss an RMD, file Form 5329 immediately. Under the new Secure 2.0 rules, the penalty was reduced from 50% down to 25%. And if you correct the mistake within 2 years, the penalty drops even further to just 10%. But ignoring it is dangerous. The IRS can hit you with a 25% excise tax on the amount you should have taken out, plus regular income tax on top of that. Question number 3. Do you know your full standard deduction including the senior add-ons? This question has changed in 2025, and if you are over 65, you need to know about it. Here is what happened. On July 4th of 2025, a new law was signed. It is called the One Big Beautiful Bill Act, and one of its provisions gives seniors a brand new tax break. If you are 65 or older for tax years 2025 through 2028, you can claim an additional $6,000 deduction. If you are married and both of you are 65 or older, that becomes $12,000 combined. This is on top of the regular standard deduction, and it is on top of the existing senior add-on that has been in the tax code for years. But here is the catch. The new $6,000 deduction phases out if your modified adjusted gross income is above $75,000 for singles or $150,000 for married couples. It is fully gone above $175,000 for singles and $250,000 for couples. The trap is this. Many seniors do not even know this deduction exists. Others stack the wrong deductions or assume they have to itemize. They do not. The deduction is automatic on Form 1040. If you missed claiming the senior deductions in past years, you can still file Form 1040X, an amended return, within 3 years of the original filing date. You may be able to recover hundreds or even thousands of dollars in overpaid tax. Question number 4, and this is the question most retirees in America cannot answer. Do you know how to use a qualified charitable distribution to reduce your taxable income? If you are charitable, if you give to your church, your synagogue, your favorite nonprofit, or any qualified 501c3 charity, this question is the most important one in this entire video. Please listen carefully. A qualified charitable distribution, called a QCD, is found in Section 408 of the Internal Revenue Code. Here is how it works. If you are 70.5 years old or older, you can transfer money directly from your traditional IRA to a qualified charity. The amount counts toward your required minimum distribution, but it is excluded from your gross income. That means it does not raise your AGI. It does not raise your provisional income. It does not push you into a Medicare surcharge bracket. For the year 2025, you can give up to $108,000 this way. For 2026, that limit rises to $111,000. There is also a one-time election that lets you use up to $54,000 in 2025 or $55,000 in 2026 to fund a charitable gift annuity. Now here is why most retirees fail this question. They withdraw their RMD into their checking account first. Then they write a personal check to their charity. They think they are doing the right thing, but this destroys the entire tax benefit. The money must go directly from your IRA custodian to the charity. If it touches your bank account first, it becomes fully taxable income. Another mistake. Many seniors try to do a QCD from their 401k, but QCDs only work from IRAs. You must roll the 401k into an IRA first. The protection is huge. A properly executed QCD lowers your AGI. That can save you from Social Security taxation. It can save you from Medicare surcharges. It can save you from the 3.8% net investment income tax. It can preserve your senior bonus deduction. When done correctly, your IRA custodian sends you a Form 1099-R for the full amount. You report the QCD exclusion on Form 1040, line 4B, with the notation QCD written next to it. If you skip this strategy or execute it incorrectly, your full RMD becomes taxable, and that one mistake can ripple through every other tax rule we discussed and cost you thousands of dollars in a single year. This is why I said most retirees cannot answer question number 4, because most retirees have never even heard of a QCD, and the ones who have often do it wrong. Question number 5. Do you know the IRMAA income brackets that increase your Medicare premiums? This is the rule that hurt Robert in our story earlier. IRMA stands for Income-Related Monthly Adjustment Amount. It is published by Medicare in the official 2026 Medicare Cost Fact Sheet, publication 11-79. In 2026, the standard Medicare Part B premium is $202.90 per month. But if your modified adjusted gross income from 2 years ago, that means your 2024 tax return, was above certain thresholds, you pay more, a lot more. If you are single and your 2024 income was up to $109,000, or married up to $218,000, you pay the standard premium. But the moment you cross $1 over that line, your premium jumps to $284.10. Cross the next bracket, and it goes to $405.80. The next bracket, $527.50. The highest bracket goes all the way up to $689.90 per month. That is per person. So a married couple at the top can pay almost $1,400 a month just for Medicare Part B. And that is before Part D, which adds another $14.50 up to $91 on top of your prescription drug premium. The trap is the 2-year look back. Medicare in 2026 looks at your 2024 tax return. So a Roth conversion you did 2 years ago, or a home sale, or a one-time bonus distribution, can come back and bite you long after you forgot about it. And the brackets are cliffs, not slopes. One single dollar over the line costs you hundreds. The protection is Form SSA 44. It is officially called Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. If you had a major life event, marriage, divorce, the death of a spouse, retirement, loss of pension, or loss of income-producing property, you can ask Social Security to recalculate your premium based on your current income, not your 2024 income. If you ignore this, IRMA is automatically deducted from your Social Security check. Many seniors only notice when their deposit suddenly shrinks. Question number 6. Do you know if your pension and IRA withholding is set correctly? This is the quiet question most retirees never think about. When you were working, taxes were withheld automatically from every paycheck. You never had to worry. But the moment you retired, that responsibility shifted to you. The IRS uses Form W-4P to control withholding from periodic pension and annuity payments. Since 2023, this form was completely redesigned. It now looks like the regular W-4. And here is the problem. If you do not actively elect a withholding rate, the default treats you as single with no adjustments. That often withholds far less than you actually owe. For lump sum and non-periodic IRA distributions, a different form applies, Form W-4R. The default withholding is 10% for most IRA distributions, but for eligible rollover distributions from employer plans, 20% is mandatory. The trap is assumption. Retirees assume taxes are being withheld at the right rate, just like they were when they were working. They are not. And once Social Security starts, your tax situation becomes more complicated, not simpler. The protection is a fresh Form W-4P sent to your plan administrator. Or pay quarterly estimated taxes using Form 1040-ES. There is also an IRS safe harbor rule. As long as your total withholding and estimated payments equal at least 100% of last year's total tax, or 110% if your prior year AGI was over $150,000, you will not owe an underpayment penalty. Skip this, and the IRS can charge you the Section 6654 underpayment penalty. As of early 2026, that interest rate is around 8% annualized. Plus, you face a surprise tax bill on April 15th. So now you have heard all 6 questions. Take a moment. Be honest with yourself. Could you answer yes to all 6? Most people cannot, and that is okay. Because now you know exactly what to ask, what to study, and what to fix. Here are the 3 exact actions I want you to take this week. Step 1. Pull out your most recent tax return and your most recent Social Security benefit statement. Sit down at the kitchen table with both documents. Calculate your provisional income using the formula I gave you. AGI plus tax-free interest plus half of your Social Security. Know your number, because that one number controls more of your retirement than almost anything else. Step 2. Visit IRS.gov and download Publication 91FIV and Publication 590B. Then go to Medicare.gov and download Publication 11579, the 2026 Medicare Costs Fact Sheet. These are free. They are official. They are written for you. Read them slowly with a cup of coffee. Underline anything you do not understand. Step 3. Before you make any large withdrawal, any Roth conversion, any home sale, or any pension change, stop. Call a qualified tax professional or a fiduciary financial advisor. One conversation, 1 hour of their time, can save you thousands of dollars in IRMA surcharges, RMD penalties, and Social Security taxation. Now please listen to me carefully before you go. The rules I just shared with you change every single year. Income thresholds shift. Medicare brackets adjust. New laws like the One Big Beautiful Bill Act appear out of nowhere. And YouTube does not always send you notifications when I post a new video. The platform decides what you see. Not me. Not you. So if you want to stay protected, if you want real-time alerts about Social Security changes, pension rules, bank regulations, insurance policies, and travel rules that affect seniors, please do this one thing for me right now. Click the link in the description below this video. Join the Global Senior Alerts official WhatsApp channel. It is completely free. When you join, you will receive a free download of our Senior Benefits Protection Guide. And you will get instant alerts whenever a major rule changes that could affect your retirement, your money, or your safety. Do not rely only on YouTube to keep you informed. Your retirement is too important. Your peace of mind is too important. You worked your whole life for this. Protect it. I am Masha. Thank you for spending this time with me today. Stay safe, stay informed, and I will see you in the next video.